This week's video is actually part one of a two-part series on my channel. So this week, I'm going to be talking through the AI trade and how you could buy the dip in the US stock market. And the next week, I'm going to be discussing how you actually implement this in a portfolio. So let's zoom out here. So the S&P 500 is down about 8% from its all-time highs in January, and the Nasdaq 100 is down over 10% from its all-time highs. So a correction is about a 10% downward move in the price action of an index. So the Nasdaq 100 is well within a correction, and the S&P 500 is hovering just outside of correction territory. And you might be wondering, why does this matter? So historically, when the Nasdaq enters correction territory over the next 12 months, it averages about 22% returns. So a lot of times when the market is down, like it's been in the last couple of weeks because of the volatility from the Iran war and the Fed saying they're not going to lower rates across the next year, people freak out. They go to cash, they go risk off, but it's the exact opposite of what you should be doing. These are the opportunities where you actually make the most money. So what I want to discuss is something called strategic versus tactical allocations. So strategy is your overarching plan for your portfolio. This is what you're going to carry through year to year, decade to decade, all the way through your investment horizon. And tactical allocations are when you make short-term adjustments of 5 to 10% of your portfolio balance to try and take advantage of market opportunities, market inefficiencies, or things that you see in the market. So at this juncture, you have a tactical opportunity to allocate towards equities to try and take advantage of the potential upside now that the market is in a market correction. And I'm going to be talking through how you can best take advantage of this tactical opportunity. The stock market doesn't actually care about all this geopolitical risk.
We do not care.
It will make those short-term movements, those short-term price fluctuations. But at the end of the day, the price that you see in the stock market is a reflection of the corporate earnings of the underlying companies. And the baseline assumptions for what these companies are going to be producing in revenue, what their profit margins are going to be, has been revised up. This is going to be the third year in a row that these corporations are seeing double-digit earnings growth. They're projecting between 13 to 17% growth this year, which is astounding, especially considering how much money these corporations are already making. So with that backdrop and with the knowledge that we have all this AI infrastructure, we have all this AI investment, and we have a bunch of AI companies that are trying to IPO this year, that backdrop is set for there to be sustained growth for the next several years in the US stock market. You look at SpaceX, which actually has XAI rolled into it. They intend to IPO this year at $1.75 trillion. OpenAI, the company that brought out ChatGPT, they're planning to IPO in the fourth quarter of this year. And their biggest rival, Anthropic, which releases Claude Cowork, Opus 4.6, all those coding tools targeted at enterprise companies, they are also targeting an IPO in the fourth quarter of this year. So I expect earnings in the US stock market to continue growth well into 2030. And I'm actually allocating more heavily into US tech. This is not financial advice. I'm just telling you what I'm doing. So we're actually selling one of our properties and we're taking a large chunk of that money and we're allocating it into the US stock market. And we actually do have positions in a lot of these frontier AI labs in the private markets like OpenAI, Anthropic, XAI. So we will be able to participate in some of that market upside from this AI build out. So now we have to think about if we want to tactically allocate to take advantage of tech growth and the AI expansion in the US market, how do we do that? And I'm going to give you 3 different ways to do it. And each one is going to be progressively higher upside, but it also presents more volatility to your portfolio. So the first way is literally to just buy the index. I don't know how many times I've said this on this channel, but the best thing you can do is buy the index. It's very hard to beat the market over a sustained period of times. It's very hard to do individual stock picking. So if you buy the index, you're guaranteed to participate in the market upside. And the index that I like to take advantage of the tech growth and the AI growth is the Nasdaq 100. So a lot of people have heard of QQQ. It's a very solid product. It tracks the Nasdaq 100. But the one I actually prefer is VGT. It has lower expense ratios. It also tracks along with the Nasdaq 100, and it will give you better returns than just buying QQQ just because you aren't paying as much in fees. Now, the second way I would like to play the AI build out is just buying all the monopolies in the AI supply chain. So there's quite a few companies in the AI supply chain that have functional monopolies. And as the AI grows and as it builds out, these companies are going to reap the benefit. There's no ways around it. So the one that most people are familiar with is NVIDIA. So NVIDIA is one of the premier chip providers for all the frontier AI labs. They started off just selling GPUs. They've expanded out to producing full-on AI factories for people. It is a one-stop shop for your AI solutions. That full rack has everything you need to go from 0 to 100, actually doing training, doing inference, and getting your AI business off the ground. So NVIDIA has over 90% of the market share of this AI chip business, and they are functionally a monopoly. They're also been beaten down from their all-time high. They're almost 19% lower than their all-time high price, but they've been revising up their estimates of what their revenue is going to be, what the revenue growth is going to be, and the demand for their product is completely insatiable.
Right here where I stand, I see through 2027 at least $1 trillion.
So we might see a little bit more price to earnings compression for NVIDIA, but it doesn't really make sense when they're growing at a faster rate than most companies in the US stock market. And a lot of analysts have revised their price targets up for NVIDIA up to the $300 per share range, which is a bargain considering what their current prices are. The other monopolies, most people are not as familiar with. So Taiwan Semiconductor, TSM, they are actually the leading producer of semiconductors. They provide semiconductors across industries, but they are the main provider of semiconductors to NVIDIA, Intel, and a bunch of other companies. Taiwan Semi has better yields. They can get a higher transistor density than any other company, and their quality is unmatched. They are the premier semiconductor provider in the world. So Taiwan Semi does have a few competitors. Samsung, Intel, but they are in distant second place. They cannot match the yields and the transistor density that Taiwan Semi is producing. So they are well behind the quality that some of these frontier labs and NVIDIA are demanding for their actual AI infrastructure. And then we have to think about the supplier for Taiwan Semi. So Taiwan Semi, to actually produce these high yielding semiconductors, they use extreme ultraviolet lithography. And really, all you need to know about this is it allows them to make those semiconductors at smaller and smaller nanometer lengths. So the 7 nanometer, the 5 nanometer, the 3 nanometer semiconductor chips that they are producing, they can only do that with the extreme ultraviolet lithography equipment. And there is one provider in the entire world that is providing that extreme ultraviolet lithography equipment. It's ASML. ASML is a monopoly. It has no competitors. There's no one close. They're the only corporation in the entire world producing this extreme ultraviolet lithography equipment. So they are a monopoly in the AI supply chain. The third monopoly I want to talk about is SK Hynix. So SK Hynix actually is providing high bandwidth memory. So AI workloads don't just require a lot of computing power, they also require that you hold a lot of information in memory. And that high bandwidth memory that SK Hynix is producing is exactly what you need for these AI workloads. They do have a few competitors, Samsung and Micron, but as of now, SK Hynix is the market leader in high bandwidth memory. The one catch with SK Hynix is that they're not actually traded on the US stock market. They're traded on the Korean stock market. So you would actually have to jump through hoops to buy SK Hynix. And the last thing is not exactly a monopoly, it's more of an oligopoly. And these are the cloud providers for AI compute. So you've got AWS, which is Amazon. You have Azure, which is Microsoft. You have Google Cloud Computing, which is obviously Alphabet and Google. And then you have Meta. So these four companies are providing the majority of the cloud AI compute services for frontier labs and AI startups. And if you're starting an AI company, buying the hardware yourself, standing up your own data centers, doing all that heavy capital intensive work is out of reach. So you have to go to one of these cloud providers to actually get off the ground and get your product running. So those are the monopolies. Those are the things that you could buy and take advantage of the AI trade. They're almost all guaranteed to go up if AI pans out to be the transformational technology that it's looking like it's going to be. There's been a rollout of a bunch of AI agents. You can see that companies are starting to actually lay off employees, or they've implemented hiring freezes to not bring on new employees, and they are actually backfilling with AI. And I would only expect this to accelerate as time goes on. So the first trade was the index, the second trade was the monopolies, and the third trade is to buy the different layers of the AI supply chain. So this one actually has the highest upside of the three trades. So when we're thinking about AI, there's actually 5 layers to it. So you have energy, you have infrastructure, you have chips, you have frontier models, and then you have applications. And if you constructed a portfolio where you bought in all the 5 layers, the highest upside market participant, then you could easily take advantage of this AI trade. But this one has more volatility associated with it and is not as guaranteed as the first two trades. But with that volatility, you get way more upside. So let's go layer by layer. So my energy selection would be Bloom Energy. So a lot of these AI data centers, they're running into bottlenecks on power. They want to connect to the grid, but there isn't sufficient power in that area to power their data center. And they're hitting 1 year to 3 year bottlenecks before that energy is going to come online to supply their data center. And this is where Bloom Energy comes in. They provide solid oxide fuel systems. So what it is it's a fuel cell that you can set up on site of these data centers, and it actually is base load for the grid. And they can deploy these systems within 3 months instead of 1 to 3 years. And all they're doing is they're combining oxygen with a fuel, either hydrogen or natural gas. And as a byproduct, you get water and CO2. It spits off free electrons, which are creating the energy. And that energy is getting supplied to the data center. And their business has been booming. They've been signing contracts left and right to bring people on board who are hitting that energy bottleneck when they're trying to build out their data centers. And if you look at them over the last year, their stock has absolutely exploded. And I don't actually see it slowing down anytime soon. The next layer is infrastructure. So a lot of those cloud providers are in that infrastructure layer. They're providing AI compute at a price. When you look at those hyperscaler names for AI cloud services, it's not just a tailor-made solution for AI. They're doing storage, they're doing security, and then they happen to also do AI compute. Where if you look at a company like CoreWeave, they are specifically optimized for AI compute workloads, training your model, running inference on your model, and they are leasing their AI compute to a bunch of frontier labs. So they have a lot of upside, and the demand for AI compute is just starting to skyrocket. These AI models have just started rolling out, and their use cases have not even fully been fleshed out yet. So I imagine over the next 5 to 10 years, their business is going to grow substantially. So then the next layer down is chips. And this one is pretty obvious for me. NVIDIA, they have a monopoly on it. Their revenue is growing like crazy. They are ahead of everyone else as far as training workloads, their inference workloads. They are the best of the best. And year after year, they're going to innovate and make everything that they build backwards compatible. So the key advantage for NVIDIA is actually their coding language, CUDA. This is what makes everything backwards compatible. And this is their moat. The fact that you have to convert your entire code base away from CUDA into some other language is why the transition costs are so high and why all their enterprise clients are so sticky. Because you know that NVIDIA is going to continue to innovate and continue to bring the very best hardware. And if you switched, you do not have those same guarantees that everything's going to be backwards compatible and that they're going to keep innovating and delivering year after year after year. So then we get to models. So right now, the only frontier model that you can really purchase on the US stock market is Google. So Google's Gemini model is an excellent model. It has some of the best image generation with Nano Banana. It's great for just simple solutions. And that's really the only frontier model that you can purchase on the US stock market right now. By the end of the year, you'll have IPOs of SpaceX, which rolls in XAI, which is Grok. And then you'll have Anthropic, which is Claude. And then you'll have OpenAI, which is ChatGPT. But none of these companies have IPO'd yet, so they're not publicly available to trade. But I did an entire video on why I think Google is the one stock that you should purchase in this AI market, because they actually have exposure to all 5 layers of the AI business. And you guys can check that video out if you're curious why I made this argument. And then the last layer is apps. So there's actually a bunch of companies operating in this apps layer, but the one that I really, really like is Palantir. So Palantir is like a preferred US defense contractor. They actually provide software solutions for enterprise companies, governments, and AI integration for companies. So they have 3 different platforms. So Gotham is their defense and intelligence platform that takes data and provides insights to make command decisions. And then Foundry is that enterprise solution, which is providing that same capability for healthcare, finance, manufacturing. It's looking at all that data stack and providing you insights to make better decisions and more optimally run your business. And the last one is artificial intelligence platform. It's AIP. And this is giving companies the ability to integrate these large language models into their private networks in a safe and secure way. So those are the 5 layers: Bloom Energy, CoreWeave, NVIDIA, Google, Palantir. And like I said, there was 3 different ways to play it between buying the index, buying the monopolies, and buying the 5 layers. And if today's video gave you some insight on what you should be considering buying, then you want to tune in next week for when I discuss the exact way to construct this portfolio, going in depth and showing you what that tactical allocation will look like in your portfolio. Thanks for tuning in, and I'll catch you next time.
Understand the market, keep your vision on the prize, building up the wealth right in front of your eyes. Talk Higgins, yeah, we keep it moving. Talk Higgins, watch the wealth improving. Markets and the money, making sense of the math, helping you navigate the financial path. Talk Higgins, subscribe for the vision. Stay smart, stay invested. We out.